Hello and welcome back to Trading Club 7. You am your lead educator, and today we're on lesson 47 of our fundamental and macro context module. Our topic for today is earnings, guidance, and valuation basics, which can be overwhelming for many beginners. Have you ever tried to make sense of a company's quarterly earnings report only to end up more confused than before? We're going to change that today. The truth is, earnings reports can provide valuable insights into a company's financial health and performance, but it requires understanding the basics. So, let's start with the concept of earnings. Simply put, earnings are the profits a company makes after deducting all its expenses, including taxes, from its revenues. Think of it like running a lemonade stand. Your revenue is the amount of lemonade you sell, while your expenses include the cost of lemons, sugar, cups, and other supplies. Let's use a real-life example with simple numbers. Suppose we own a lemonade stand that sells 100 cups of lemonade per day for 1 each. Our total revenue would be 100 per day. Now, let's say our expenses include 30 for lemons, sugar, cups, and other supplies, and 10 for the electricity bill. Our total expenses would be 40 per day. To find our daily earnings, we simply subtract our expenses from our revenue. 100 revenue, 40 expenses, 60 earnings. Easy, right? Now that we understand earnings, let's move on to guidance and valuation. Guidance refers to a company's projected performance over a certain period, usually quarterly or annually. Think of it like setting a target for your lemonade stand. If you expect to sell 120 cups of lemonade per day in the next quarter, that's your guidance. Valuation, on the other hand, is how much investors are willing to pay for a company's shares based on its earnings and guidance. Here's where beginners often make a common mistake. They focus solely on a company's short-term earnings and guidance rather than considering its long-term valuation. This is like buying a house and only thinking about how much you can afford for the down payment without considering the monthly mortgage payments, property taxes, and maintenance costs. Another mistake is not accounting for any potential changes in a company's business model, market trends, or economic conditions that could impact its future performance. Think of it this way: a company's earnings and guidance are like a snapshot in time. However, the valuation of a company's shares is like a moving picture, with many variables at play. To avoid these mistakes, always consider the following. What are a company's historical earnings trends? Are they increasing, decreasing, or stable? Is the guidance overly optimistic or conservative? How does the company's valuation compare to its industry peers and historical metrics? For example, if a company's price-to-earnings ratio is higher than its historical average, is it due to its strong growth prospects or overvaluation? Let's look at some real-world examples. Suppose we have two companies, A and B, in the same industry. Company A has a higher earnings growth rate, but a lower price-to-earnings ratio compared to company B. Which company would you rather invest in? The answer may not be so clear-cut, as we need to consider other factors, such as management quality, competitive positioning, and industry trends. Now, let's put this theory into practice with a practical exercise. Take a demo chart or paper trading journal, and find a stock that interests you. Research its recent earnings report, guidance, and valuation. Write down your observations on the following. What are the company's historical earnings trends? Is the guidance overly optimistic or conservative? How does the company's valuation compare to its industry peers and historical metrics? Don't just stop at the numbers, also consider the company's management quality, competitive positioning, and industry trends. Here's a homework exercise. Remember, trading involves risks, and there are no guarantees of profits. Always practice on a demo account before risking capital. That's it for today's lesson on earnings, guidance, and valuation basics. I hope this explanation has removed some of the confusion surrounding these concepts. If you're new to trading, don't worry, you've got this. The key is to always take it one step at a time, and to practice patience and discipline. Don't forget to subscribe to our